The next biggest thing that the banks are really going to use to determine how much buying power you have is your debt to income ratio. Basically what that is, if you divide your total income over your debts, how much is left over, that percentage. So if you make $10,000 a month and your total debts on credit, mortgage, anything that's showing on your credit report. So this doesn't include like utility bills. So you make 10,000, you spend 5,000 a month, your debt to income ratio is about 50%. That's really where lenders kind of start to max you out. They want to see that all of your debts combined are less than 50%. There are cases where they'll go higher than that. I know VA loans will let you go up to about 55%, but these are changing all the time. Most of them have a sweet spot, which is about 43% of your total income. There's two different types of debt to income. There's your front end ratio or front end DTI, which is just your mortgage and the different housing expenses with that. That could be your mortgage payment, your taxes, insurance. If you have mortgage insurance, a homeowners association dues, that's all included in your front end ratio. So you take your total income, all of your mortgage expenses, and when you divide that out, that's going to give you your front end DTI or front end debt to income ratio. Next, you have your back end debt to income ratio, which that includes all of your mortgage expenses, any other expenses you have that's showing on credit. So it could be car payments, credit cards, alimony, or child support that you're paying. So that's your income over all of your other debts. That's your back end ratio. What banks typically want to see is that you have a fairly low front end ratio, which means your mortgage payment is a lot less than your total debt payments. They don't care if both of them are low, that's great. If your total debts and your mortgage are pretty low compared to how much you make, you're in good shape. But if your mortgage payment is almost half your income, they see that as riskier because you're going to have a harder time being able to pay that mortgage. But if your mortgage payment's really low or your future mortgage payment's really low, but you have a lot of debts that's close to half your income, that's seen as less risky because if you have to give up, a car, or you end up having issues paying those bills, at least they know that you make enough to pay your mortgage. So those are the two big things when it comes to your debt to income ratio. And there's also your employment that they want to look at. So are you W-2'd, self-employed? Do you show income? So when you're W-2'd, that's typically the safest route that you can go. They look at it as it's more secure than if you're 1099 or you're self-employed. And the reason for that is you're getting usually a standard check every single month, and you're not able to write off as much on your taxes. So when you're W-2, they want to at least see that you've been in the same line of work for about 2 years, unless you just graduated, right? Maybe you were in a nursing program and you just got your certifications, or you were in the military and you just finished with the military. Now you have a new job. Then they're not as strict. They want to see your transcripts, or they want to see your DD-214 if you're a veteran. And then you don't need to have that 2-year history, but you can have gaps in that as well. So let's say you were working for 10 years, then you took 2 years off and you went back to work. They're going to want to see those prior years. Or let's say you were sick, or you were on disability for a little bit. That's fine. They just want to see the past and that you're currently working. And usually they're going to take whatever your current pay is. That's what they're going to use to determine how much income you're getting. When you're self-employed, it's a little bit different. What they want to see is typically 2 years of tax returns. And then they're going to look at the adjusted gross. There's so many different things that can go into how they calculate the tax returns, which I'll do another video on that. But when you're self-employed, if you're showing that you're making more each year, then they're going to usually do an average of the 2 years. If you're showing that you're making less or your income's declining, then they're going to want to use that declining income. So you want to be careful. Talk to your accountant, make sure they're not taking too many write-offs, especially if you're going to get a mortgage. You don't want to write off all your income. The banks are going to look at that and they're not going to want to lend to you. Or if you've done any adjustments where you've gone back and refiled your tax returns after you've done a mortgage, they're going to look at that too as you're risky or you're lying about your income. So you always want to be super careful with how you're filing your taxes. You don't want anything to show up where you could possibly get in trouble. But typically 2 years for taxes as well if you're self-employed. They want to see that you've had this business for a long enough time where you've established yourself, because you're your own boss, right? So they want to make sure that the business isn't going up and down, or you just started today and you're making a lot of money right now, but it could just be a fluke. So the other different types of income, Social Security, disability, alimony, child support, any of those, you can use all those as well. You can actually qualify for more if you have it on your taxes. Typically it can be up to 125% with Social Security, but they are going to want to look at your returns. This also changes all the time, so you want to make sure that your lender is up to date on their guidelines and they're using as much income as possible. Another way that the banks are going to look at whether you can qualify or not is called a cash flow analysis. And the way that they look at that is, does the property cash flow? So if you're buying this, it's not your primary residence, instead you're purchasing an investment property, then they'll look at, does the total debts on the property, are those less than what you're bringing in? So let's say the projected rents are $3,000 and the total debts in the property are $4,000. That property doesn't cash flow, so the banks aren't going to want to lend on that. Another thing that they consider too is if it's a property that you're getting ready to buy and you're not currently renting it out, then they're not going to give you the entire amount of what it could rent for. So if we consider this property would rent for about $4,000 a month, they're going to give you about 75% of what that is. So you're really only going to be able to use $3,000 of that income. So those are all different ways that you can qualify. If you can't qualify for a typical conventional loan, VA, FHA, because of your income, or maybe you wrote too much off, or maybe you got a lot of cash payments, then there are different options available. There's bank statement loans, there's hard money, there's stated income, but those do come with higher interest rates. So you're going to be paying for it in your monthly payment when you go with the determined riskier loan. So there's always ways to get you qualified, but some programs are better than others.